Hey everyone, and welcome to the final episode of the Investing 101 series. We have made it to the end. If you have watched this entire thing from start to finish, I greatly appreciate the watch time. With that said, let's get into it. So this is part 11 of 11, and the episode title is What's Next? So this is roughly what I wanted to talk about. I first wanted to touch on the idea of investing in real estate and some of the things you should look out for. I also wanted to talk briefly about crypto because I've referenced it several times and I wanted to give you a basic introduction to it and probably some words of caution as well. And speaking of caution, I'm also going to talk about margin trading, and big disclaimer, this is not financial advice. This is just me putting a bunch of words together in sequence, talking about stuff. This is purely for educational purposes so that you're aware of the fact that margin trading exists, and then you can go read about it and develop your own opinions about it. And finally, I want to raise the question of whether or not I should make an Investing 201 series or a 102 series or whatever, and I want your feedback on that. Okay, so let's talk about real estate. So I've talked in previous videos about asset classes. You've got stocks, you've got bonds, you've got cash, you've got crypto, you've got commodities, and another good asset class that you can diversify into is real estate. You can actually get some pretty easy exposure to this using REITs or other real estate related index funds, and I've talked about that in previous videos. I believe I talked about that in my basic strategy video, so check that out. The entire playlist is linked in the description, along with a bunch of other information that you should check out and some affiliate links that you should click on if you would like some free money and you would like to give me some free money. So most likely you probably won't have all the cash to buy a house outright. If you do, that's great, but generally you'll probably have to get a mortgage. And I'm going to talk more about mortgages in the next few slides. But in the context of real estate as an investment, as you pay down principal on your mortgage, any principal that you pay down gets added to your total equity. So if you want to track your net worth, any principal that you've paid off on your mortgage is part of that net worth. In addition to merely functioning as an investment that you buy at one point in time and then sell at a later point in time, you can also think of real estate as a way to earn passive income. This could be in the form of rental income if you rented out your house or a room in your house to someone, or it could even be an Airbnb, depending on your local regulations and stuff. So if you're trying to get a mortgage for a house, you probably already know this, but there's two different types of mortgages that you can get. You can get what's called a traditional mortgage or traditional loan. Generally, you put 20% down, and ideally you have a fixed rate mortgage, either 15-year or 30-year. I'm going to be going through this process in the next year, hopefully. So later I will hopefully have some videos that go much more in depth on this topic. You also have something called the FHA loan. And the FHA loan is a federal loan that allows you to do a down payment as low as 3.5%. Keep in mind, if you're putting a down payment that's less than 20%, you're going to have to get what's called private mortgage insurance. Now, it might be tempting to go with a low down payment, but the private mortgage insurance will definitely add up. So you really have to crunch the numbers and see what your buying power is. And there's a lot of things outside of the mortgage that you have to keep in mind as well, like property tax, which can be high depending on where you live. Here in the Bay Area, it is unreal. And then you also have stuff like HOA, utilities, repairs, and maintenance. So you really want to do your due diligence before you even get anywhere close to this. And another thing that you want to do is before you go shopping for a house, you want to get pre-qualified with a lender. I think for now, since I don't have any videos on this topic, I will redirect you to a comprehensive video by Meet Kevin and a video by Graham Stephan, because I enjoy both of those videos, and I will link them in the description. So I just wanted to briefly cover real estate. Let's talk about crypto. Cryptocurrencies are an exciting new asset class that's emerging thanks to the internet. I'm pretty sure you've heard about Bitcoin, and Bitcoin is the cryptocurrency that started it all, but there are hundreds and hundreds of cryptocurrencies right now. I'm actually editing right now and it's over 4,000. So here are some of the characteristics of cryptocurrencies. First of all, they rely on a distributed ledger known as a blockchain. Whenever you make transactions, those transactions end up on that blockchain. There's a starting point, which is the very first block with the very first transaction of Bitcoin, and blocks of transactions are added sequentially onto that. So you can go on a website and you can see every single transaction. You can see how much it cost. You can see the source wallet address. You can see the destination wallet address. Imagine a country's tax dollars all being on a public ledger so that you can see exactly where every single dollar goes. In addition, most cryptocurrencies have a feature called mining. And mining or validation is a mechanism that you use to verify transactions. And these usually fall into one of two categories, proof of work or proof of stake. With proof of work, you're doing computationally expensive work, and this is a way to make it significantly difficult to do any sort of manipulation of the blockchain. One of the problems with proof of work is that it uses a lot of electricity. Thankfully, about 70% of that electricity is currently based on renewables, in large part thanks to the fact that now renewables are cheaper than fossil fuels, especially solar, which makes me so excited. And these could potentially be used ad hoc whenever the grid doesn't require the extra power. But proof of work still makes this very prohibitive, and it also has a negative impact on the GPU industry, because as of right now, there are several cryptocurrencies that can be profitably mined using GPUs, and GPUs are also used for gaming. And so if anyone's trying to build a PC right now, they're going to have a really hard time finding GPUs. So because of the power constraints and the cost constraints, proof of work is a model that I don't think is completely ideal. There are a few cryptocurrencies that are using something called proof of stake. Proof of stake basically means that you stake some of your currency, whatever that currency happens to be, let's say Ethereum, and you lock it up in something similar to an escrow account where you cannot touch it for a predetermined amount of time. But by staking that Ether, you can participate in validating transactions. And by validating transactions, you earn income in the form of transaction fees. Cryptocurrencies use something called wallets. Wallets are identified by a public and private key. The private key is something that you never share with anyone. The public key is something that you share whenever you send or receive money. Fungibility is basically the idea that a cryptocurrency is something that you can subdivide. And the important part is that even whenever you subdivide the cryptocurrency, it retains its value. That value is proportional to the fraction that you subdivide it into. And finally, cryptocurrencies are pseudonymous or pseudonymous, whatever, however you want to pronounce that. And some of them are actually anonymous, and I'll talk about that later. Pseudonymity just means that you don't actually use your real information. So here are some popular cryptocurrency coins. First, you've got Bitcoin using the symbol BTC, and this is probably the one that's most familiar to everyone. It's a great store of value. You can think of it as a digital gold, and it's a deflationary currency because the total supply of Bitcoin is finite. There are only 21 million in existence in the entire world forever. So if you have one Bitcoin, you are 1 in 21 million, and just think about how many people there are in the world. So that's actually a pretty big deal. Currently, I have around 1/3 of a Bitcoin, and I'm working on adding more to my portfolio over time. Hopefully, I'll get to 1 Bitcoin before it gets too expensive. There's another popular coin called Ethereum, and Ethereum took everything about Bitcoin and added so much more. It added smart contracts, it added gas fees. There's too much to go into in this one video alone, but suffice to say that Ethereum is a very versatile coin that will be involved in transactions across the entire cryptocurrency industry, including other cryptocurrencies. Ethereum is a really exciting technology, and I am so excited to see where that goes in the future. And I wanted to mention Monero because of the anonymity feature that I mentioned in the previous slide. Monero is basically like Bitcoin in that you see a public ledger, and that public ledger is secure and immutable. However, the sender, the receiver, and the amount that was transferred is not shown in that ledger. So Monero is basically the closest analog to physical cash where the transactions are not traced back to you. So it's basically censorship resistant, and it offers privacy. And this does have legitimate uses outside of the obvious illegal uses. And there are hundreds of other coins. One thing to keep in mind about crypto is that they are taxed like property. So the taxation structure is actually very similar to stocks. You have short-term capital gains and you have long-term capital gains. Long-term kicks in after a year, and you realize those gains whenever you incur taxable events. The two taxable events that you should know about are selling your cryptocurrency in exchange for actual money, like a fiat currency, like US dollars, or exchanging your cryptocurrency for another type of cryptocurrency. So let's say you converted Bitcoin to Ethereum. You would be taxed on the gains that you made on Bitcoin, between the time that you bought it and the time that you transferred it. Hopefully regulation over that second part changes in the next few years, because not being taxed whenever you exchange one cryptocurrency type for another will open a lot of doors for some really interesting stuff like Uniswaps. If you transfer your cryptocurrency from one wallet to another and you own both of those wallets, or if you transfer from an exchange to a wallet or from a wallet to an exchange and you own that exchange account, then that is not a taxable event. So go nuts. Just know that you will be taxed if you sell it for money or if you change it into another type. And for a complete guide, you can check out the FAQ that I have linked in the slide deck, which is linked in the description. Margin. Now, before I talk about margin, I just want to give a disclaimer. This is not financial advice. Please do not take this and go out and open a margin account and get a bunch of margin. You need to read about margins. You need to watch videos about it. You need to understand what you're doing before you even start, because margin trading can lose you a lot of money if you're not careful. So margin trading allows you to borrow money based on your portfolio in your stock brokerage account. Typically, brokers allow you to borrow up to 50%, some say 30%. Honestly, I would not borrow any more than 20%. If your portfolio drops below a certain amount, you will get a margin call. Whenever you get a margin call, you either have to transfer money from your bank account into your brokerage account to cover it, or the broker will just liquidate your positions in order to bring you below that threshold. And if that happens, that is really bad news. So Robinhood and M1 Finance both offer margin accounts. I have margin on both of those, but I would recommend sticking with M1 Finance if you are going to do margin. And like I said before, you're doing this at your own risk, and I am not responsible for you losing a lot of money. So margin trading magnifies both your gains and your losses. And the important thing to remember is that if you incur losses and those losses bring you below the margin call threshold, you could easily triple your losses, because what are they going to do? They're going to liquidate your positions. And by liquidating some of your positions, it brings down your total position in that brokerage account. And when that total position is brought down, you are even higher above the margin call threshold. So this can quickly snowball and cause you to lose triple of what you actually would have lost without the margin call. It's probably okay to have a conservative margin on your brokerage accounts. I have around 15 to 20%. I will never go above 20%. And I'm only doing this because I have enough money across my emergency funds and opportunity funds in order to pay this off if I absolutely have to. And I will get a margin call right now if my portfolio drops by roughly 76%. So I am in a very safe position, but it is possible for the market to drop by that much. It's improbable, but it can happen. If you do decide to margin trade, you need to keep a close eye on your balance and what your margin call threshold is, and you should ideally do this daily, and that can be really stressful. Meet Kevin made a really good video about the psychology of margin trading, and I highly recommend you watch that before you proceed. And finally, I just wanted to get your feedback on this Investing 101 series. Was it useful? Was it things that you already knew before? Was it too much information? Was it too little information? Let me know in the comments, and let me know using the feedback links that I put in the description of every single video on this channel. There's a Google form that you can fill out to give me feedback. So I want your feedback in the comments and on those Google forms. And I want to know, do you like these long form series? Do you want me to do more of these? I could do one about dashboards. I could do one about writing code. I could do one about, space. If you like this format, I am happy to make more videos like this, but I'm also happy to make short one-off videos like 5 to 10 minutes, something like that. If I were to do an Investing 201 series, then that would probably be a year from now. That would probably work out pretty well. As I learn more in my investing journey, I can share what I learned with you so that you can save time in learning how to do all this stuff. But yeah, that was all for this video, and that was actually the conclusion to this series. So I'm very excited to have finished this series. I really hope that this helps out someone. If this helps even one person, I'll be happy. If you know anyone that wants to get into investing, I recommend that you share this series with them. I stand by the majority of the information that I put in this video. I put a lot of research into this, and over the past year, I've put a lot of effort into learning everything I can about safely and effectively investing. So I really hope you enjoyed this series, and don't forget to join my Discord. We've got a lot of exciting stuff there. I've added a Pokemon bot so you can catch Pokemon while you chat, and I'm gonna do some exclusive live streams on the Discord itself, and maybe even giveaways. We'll see. But with that said, I will see you guys in the next video, which will not be an Investing 101 video. Bye. Bye.